There are moments in history when empires fall with explosions and fire. And then there are moments when they collapse in silence. No battles, no headlines. Just a quiet shift. So small that even the people living through it never realize the world around them has changed. 1979 was one of those moments. The year when America, the world's economic titan, didn't lose a war, didn't suffer an invasion, yet somehow lost control. And before we go any further, tell me in the comments where you're listening from. Because this story didn't just shape America, it shaped your economy too. By the end of the 1970s, the American dream was cracking at the edges. The country that had built highways across continents, sent men to the moon, and financed the rebuilding of Europe, was now trapped in a crisis it couldn't bomb or legislate its way out of. The newspapers called it stagflation, a word that didn't even exist before this era. It meant the worst of both worlds. The economy wasn't growing, yet prices kept rising. The more money people earned, the less that money could buy. In 1979, inflation in the U.S. hit 11.3%, the highest in a generation. The dollar, once the symbol of global confidence, was now sinking fast. Foreign investors started to whisper, if America can't control its own money, how can it control the world? The truth is, this collapse didn't start in 1979. It revealed itself that year. The seeds were planted long before. In 1971, when President Nixon severed the dollar's link to gold. In 1973, when OPEC weaponized oil prices. And throughout the decade, as America printed more money to fund wars, social programs, and rising debts. By the time Jimmy Carter entered the White House, the U.S. was running on fumes. The government owed billions, the average worker's salary had stopped growing, and faith in Washington had evaporated after Vietnam and Watergate. Then came the Iranian Revolution. In early 1979, the Shah of Iran, one of America's key allies, was overthrown. Chaos swept the Middle East. Oil production collapsed, and the price of crude skyrocketed overnight. Within months, gas stations across America ran dry. Lines stretched for blocks. People fought for fuel. Air travel slowed. Inflation roared even higher, feeding directly into food, rent, and manufacturing costs. To the average American, it felt like bad luck. To economists, it was something far worse, a signal that the United States no longer controlled its own destiny. Behind the scenes, world leaders started to panic. Japan and West Germany, America's biggest post-war partners, began quietly questioning the dollar's future. In London, Swiss bankers started shifting reserves into gold. And in Riyadh, the Saudi royal family, the backbone of the petrodollar system, began demanding more assurances that the U.S. could keep its currency stable. For the first time since World War II, the foundations of American financial power began to tremble, and all of it was unfolding not with tanks or treaties, but with interest rates and oil barrels. By mid-1979, President Carter faced the worst numbers of any modern U.S. president. Inflation over 11%, mortgage rates above 12%, unemployment rising, and GDP growth sliding to just over 3%, barely enough to stay afloat. Even worse, the public had lost faith. Newscasters spoke of the crisis of confidence. Polls showed Americans believed their children would be poorer than they were, a thought unthinkable just a decade earlier. Then came the final straw. In August 1979, Carter appointed Paul Volcker as the new chairman of the Federal Reserve. Volcker wasn't a politician. He was a cold, mathematical economist, the kind who believed that to fix inflation, you had to hurt the economy first. And that's exactly what he did. Within weeks, Volcker raised interest rates to levels unseen in modern history. The cost of borrowing money, for homes, cars, or businesses, soared. His plan was brutal but simple: make money so expensive that inflation would finally die. But at what cost? Factories slowed, small businesses collapsed, home buyers vanished. By the end of the year, America wasn't just battling inflation, it was facing the beginning of a full-blown recession. To the outside world, it looked like America was still in control, The military was strong. The culture still dominated global media. But behind that illusion, the empire of money was losing its grip. In just 12 months, the U.S. had seen the dollar fall, energy prices explode, and interest rates skyrocket. The financial world, once built around the unquestioned supremacy of the U.S. dollar, began to splinter. Europe started developing its own currency coordination system, the precursor to the euro. Japan began amassing reserves and building export dominance independent of Washington. And in Beijing, a little-known Chinese leader named Deng Xiaoping was quietly opening his country's economy to the world, a move that would, decades later, challenge America's economic throne. It all began in 1979, the year America quietly lost control. Not because it was defeated, but because it stopped listening to the warning signs. Every crisis since, from the 2008 financial crash to today's inflation wave, can trace its roots back to that moment when faith in the dollar cracked. And that's where part 2 begins. Because in the next chapter, we'll see how Volcker's shock therapy, raising interest rates to historic highs, didn't just reshape America's economy. It reshaped the world's financial order. When 1979 ended, it felt like America had survived the storm. But in truth, the storm had only changed direction, from outside pressure to internal transformation. Paul Volcker, the tall, stoic man who now controlled the Federal Reserve, understood something that most politicians didn't. Inflation is psychological. Once people lose faith in their currency, once they expect prices to keep rising, no law, no speech, no promise can bring that faith back, except pain. And Volcker was about to deliver it. Between 1979 and 1981, Volcker launched what economists now call the Volcker shock. He raised the federal funds rate, the base interest rate of the U.S. economy, from around 10% to an almost unbelievable 20%. To put that in perspective, borrowing money suddenly became twice as expensive overnight. For ordinary Americans, it was devastating. Mortgage payments doubled, car loans vanished, unemployment soared to 10.8%, the highest since the Great Depression. Factories in Detroit shut down. Family farms went bankrupt across the Midwest. The American middle class, the proud engine of the 20th century, was suddenly gasping for air. But Volcker didn't flinch. He called it necessary surgery. In his view, inflation was a cancer that had to be cut out completely, even if the operation nearly killed the patient. And astonishingly, it worked, at least on the surface. By late 1982, inflation had dropped dramatically, from over 11% to below 4%. The dollar began to recover. Confidence returned. Newspapers declared the nightmare over. But hidden beneath that victory was a transformation that would rewrite global finance forever. Because Volcker's high interest rates didn't just kill inflation. They reshaped the world's money flow. You see, when the U.S. raised its rates so high, it made American debt the most profitable investment on earth. Every foreign investor, from London bankers to Saudi princes, began pouring money into U.S. Treasury bonds. The logic was simple. Why risk your money in unstable countries when the American government is paying nearly 20% interest, backed by the world's reserve currency? That tidal wave of foreign capital flooded into Wall Street, strengthening the dollar further and cementing its dominance once again. But this time, not through gold or war, through debt. America had discovered a new weapon, the debt dollar system. From that moment on, the U.S. didn't have to export goods to grow rich. It could export dollars. Nations around the world began borrowing in U.S. currency, linking their economies directly to American interest rates. If the Federal Reserve sneezed, the rest of the world caught a fever. And while the 1979 crisis seemed to end in America, its shockwaves destroyed dozens of other economies. Latin America was the first victim. Countries like Mexico, Brazil, and Argentina had borrowed heavily in dollars during the 1970s when rates were low. But when Volcker's Fed suddenly raised those rates, their debt costs exploded overnight. By 1982, Mexico defaulted, triggering a continent-wide financial collapse. It became known as the Latin American debt crisis. Factories closed, currencies crashed, poverty surged, all because of a decision made in Washington in 1979. That was the true legacy of America's recovery. It had stabilized its own economy by exporting instability to everyone else. Meanwhile, back home, something new was happening. Something subtle, but monumental. As interest rates fell again in the mid-1980s, cheap credit flooded back into the system. Banks, freshly deregulated by new policies under Reagan, began to lend aggressively. The U.S. consumer was reborn, but now powered by credit cards and mortgages instead of savings. Debt was no longer seen as dangerous. It was celebrated. By the late 1980s, personal debt had doubled. Corporate borrowing soared, and the American government, once cautious about deficits, realized it could fund endless spending because the world would always buy its debt. The lesson of 1979 was clear. Control the flow of money, and you control everything. But every new system creates new weaknesses, and the one born from the ashes of 1979 had three fatal flaws. First, it turned the dollar from a currency into an addiction. The entire global economy became dependent on U.S. interest rates, unable to escape without collapsing. Second, it made speculation more profitable than production. When interest rates and financial engineering could make millions overnight, why build factories or create jobs? Wall Street replaced Main Street as the heartbeat of the American economy. Third, it shifted the balance of wealth. High interest rates protected the rich, who owned assets, and crushed the poor, who borrowed. By the mid-1980s, inequality began to soar. The top 1% grew richer than ever, while the working class fell deeper into debt. This wasn't a coincidence. It was the logical consequence of the solution to 1979's collapse. Now, step back for a moment. If the Great Depression of the 1930s created America's industrial power, and World War II created its global empire, then the forgotten collapse of 1979 created its financial empire. The old empire was built on gold, manufacturing, and oil. The new one was built on interest rates, debt, and the illusion of stability. Volcker E.S. Cure had saved the dollar, but it also turned it into a tool of control. Every central bank that followed began to play the same game, tightening, loosening, manipulating money flows to manage politics and power. By the 1990s, the world didn't just trade with America, it owed America. The system of global finance had quietly shifted from productivity to paper wealth, and it all started with one silent collapse, the one nobody remembers. If you've been watching until now, think about this. In 1979, the United States didn't fall. It evolved. It traded real control over industry, over wages, over production, for financial control over everyone else. And that's why, even today, every time inflation rises, every time the Fed raises rates, every time global markets shake, we're still living inside the consequences of 1979. It was the year when money stopped being a tool of the people and became a weapon of the few. A quiet revolution, not in politics or war, but in trust. Because once trust leaves the currency, the collapse has already begun. So next time you hear the phrase, the strong dollar, remember, strength always comes at a cost. And the real cost of 1979 wasn't just inflation or interest rates, it was control. Control that slipped away, quietly, completely, and forever.